Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Thanks for tuning in to our Real Estate 360 program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition of Real Estate 360. Comes to you daily Monday through Friday at 3 p.m. and Wednesday and Thursday at 2 p.m., along with my co-hosts Joe Kuchera and Laurie Graymont. If you can't make the live show, you can watch your podcast on RE360radio.com, and my programs on TomWilsonProperties.com or on iTunes. We have a great program for you today. We have in our studio Sean O'Toole, who is a self-made, self-taught economist and entrepreneur, and the CEO and founder for Foreclosure Radar and Property Radar. And we'll bring him in just a minute, but I want to let you know first that if you go to TomWilsonProperties.com, you can sign up for a free weekly economics newsletter written by an economist that Sean and I know, Howard Blum, who boils down everything that's going on in the country and world for a nice couple-minute read each week, and as it applies to real estate. And we, of course, protect that email and sign up that you give. Also, if you'd like to have a report on how to choose the best metro and the best product for investing in for long-term hold, we have a 19-page report with a lot of data and graphs regarding that. And if you have questions or if you have suggestions on topics or guests, we'd like to hear that. And if you'd like some free consultation on taking a look at your portfolio or objectives relative to real estate investing, I'm always glad to do that as well. Sean O'Toole is CEO and property and founder of PropertyRadar.com, formerly ForeclosureRadar.com, the leading website and data source for foreclosure information, and the only one that has daily updates on all foreclosure auctions. Prior to launching these two websites and sources, Sean was an entrepreneur in Silicon Valley with 3 startup companies. He then switched to real estate investing and flipped 150 properties. So he's been out there in the field getting his hands dirty. 150 properties is nothing insignificant. He was smart enough to figure out when to stop and get out of that, and also realized that the process that he had to go through in order to get the information he needed to make good decisions on these flips was pretty arduous. And he thought, gosh, must be some other folks out there that could use some help and some efficiency in that process. So he used his IT and background and success and put together a team and came out with Foreclosure Radar, and more recently Property Radar. And we're so glad to have Sean on the program. He's been a great contributor to our local real estate clubs and groups, a great speaker, and a good friend. Welcome to the program, Sean.
Hi, Tom. Thanks for having me.
I'm very glad to have you, and I know you're swamped with the introduction of your new product and new website, and we appreciate you making the time to be in the studio today with us.
Happy to be here.
Sean, I want to, since you're one of my most respected self-taught economists, and it's which I know is from the mother of invention, right? You needed it, needed to learn.
Yeah, well, I bought a real estate magazine in the late '80s in Hawaii, and it was right as the economy turned and stuff happened in Japan, and it was a tough lesson, and a lesson I didn't want to learn again. So I took a lot from that, and I paid a lot of attention to the economy after that, because it was a good business and a great place to be, but it was absolutely the worst market timing. And that was kind of when I first learned market timing. And I wasn't old enough to drink yet.
Well, you learned a lot sooner than most people do, and some people go through their whole lives and never quite figure that out. There's no absolute predictions, but there's certainly a lot of indicators, right, that we can utilize. And I think unlike maybe stock market, housing rarely turns in hours or days, right? We usually have warning signs.
Well, that's the great part about housing, right? Is it doesn't change overnight, and you really have to not listen to the signs and avoid the signals to get hurt badly. It does change, there's no question, but it changes a lot more slowly than equities markets or commodities markets or other things, for sure.
Well, I've been investing for 37 years, and I've certainly seen ups and downs, and was hurt by some and took advantage of some. But indeed, in those 37 years and the 44 that I've been in Silicon Valley, I've never seen anything quite as dynamic and roller coaster as what we just went through. And I certainly, in the past cycles, I'd always noticed that when the employment got bad here in Silicon Valley and jobs went away, boom, housing always took a downturn. So when the dot-com bust happened in 2000, I figured it was time to maybe start thinking about getting out. And I went against my logic at that time because I had a daughter down in San Luis Obispo at Cal Poly. I wanted her to be able to have be in a stable housing situation down there and teach her a little something about managing rental properties. So I got a house that was pretty close to campus, thinking that would help protect some of the swings, and indeed it did. But I sure thought it was going to take a bust then, but I was wrong. It did not. It kept going up. So what do we have? Do we have a housing bubble or a credit bubble?
Oh, it was clearly a credit bubble, not a housing bubble.
Explain that to us.
Yeah, so one of the things that we went back and looked at, kind of over this whole period of time, and a tool that I still use today is, especially when you're looking at median prices for the state, I take the median income and I qualify that person, right? So the median income in California today is like $68,000 household income. And, back in 2000, it was 50 some odd $1,000, I believe. And if you take that median income and you qualify them with the kind of most popular but aggressive loan program of that particular year, you find that payment's pretty consistent, right? Whatever the maximum somebody can buy is turns out to be the median price for that year. So in 2000, we had a median income of around $50,000. We had a median price of $250. Because the Fed tried to rescue the credit bubble by lowering interest rates, it got cheaper to buy more house. And in 2001, we saw prices go up. But guess what? They went up exactly by what people could now afford thanks to lower interest rates. As we get into 2003, 2004, you have the 5-1 interest-only arm, and now that same person with that same income can afford more house. But because everybody can afford more house, you don't actually get more house. House prices just go up. And we saw this all the way up to the peak where we go from $250 in 2000 to $550 in 2006. But at $550,000 in 2006, you take that median household income person, and that's what they qualify for. So, and that's all a function of credit. It's not a function of income. It's not a function of supply and demand. It's not a function of any of these other things. It's just a function of credit. And as credit gets cheaper, people can afford to pay more. Fast forward to 2009, everybody says, well, house prices fell due to foreclosures. And I don't believe that's true at all. In 2009, after they removed all those pay option arms and crazy programs, you take the median household income, they could afford $275,000. Guess what the median price was? $275,000. Fast forward to today, take the median income in California, and they can afford $360,000 or $370,000, and median price right now is $375,000. It's been true as far as we've measured it.
So so affordability index is one of the leading indicators of what people can buy.
It should be. The problem with an affordability index is it assumes that all of those terms are fairly fixed. It may adjust for interest rate, but it always assumes people buy with a 30-year fixed rate, 20% down mortgage. And that's what kind of the affordability index is based on. But and there's what people can really afford, which is a different question than what their banker tells them they can afford. And prices are based on what bankers tell you can afford.
So did values really go up?
No, I don't think so. I think the whole bubble we saw through 2006, was a artificial, reaction to changes in credit terms, and it was a credit bubble. As far as a housing bubble, people did what they always did. They bought as much houses their banker told them they could afford. And if you look at payments were relatively flat. Your possible payment. It was a pay option arm with a 1.25% teaser rate at the peak, but it was still, $1,500-$1,700 a payment, and that was true throughout that whole period of time and remains true today.
So these loans that were not normal free market loans, were these the result of the greedy, stinking banks, or did politics drive this?
Yeah, I think, I love how Washington has, said, it's these bankers. And of course, they haven't prosecuted the bankers because the bankers fund their political campaigns. But if you really, take it back, you need to look at things like the Glass-Steagall in 1999, the Commodities Futures Modernization Act, the deregulation of banks, where they were able to make these crazy loans but not take any of the risk.
So there seemed to be certainly for several administrations, some political motivation to get everybody in a house, whether they could afford it or not, wasn't there?
I don't think that's a bad goal for this country. I don't personally believe. What I think is crazy is that when we have prices at a total premium, $550,000 median price in California, they would give anybody with a pulse a loan. And we shouldn't have, because prices were too high. In 2009, when prices were at $275 median in California, we should have given anyone with a pulse a loan because there was no risk of loss, right? And if you had a pulse and you didn't make your payment, take the house from the person that doesn't make their payment. Foreclosure is not bad. You're not making a payment on the house. You should no longer get the house. Move it to somebody who can make the payment. There would have been no losses whatsoever to make pulse loans in 2009. Making pulse loans when the market is double, in price, what it really is worth, crazy to make those loans.
So to some degree, the loan ought to be based maybe a little bit more on the product and a little bit less on the person.
I don't think borrower matters really at all if the price is right, because at the end of the day, you can move that borrower out, move somebody else in, and there's no risk of loss.
We'll be back here in just a moment. We have Sean O'Toole in the studio today, the CEO and founder of Foreclosure Radar and Property Radar. And we'll continue with more topics in just a moment. This is Tom Wilson, Real Estate 360, KDOW 1220 AM, the Wall Street Business Network.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We have in our studio today Sean O'Toole, who's CEO and founder of Foreclosure Radar and now Property Radar. Also a self-taught economist who's helping us dissect what happened in this past several years. And the reason for my wanting to dig into that a bit is I think a lot of people tend to run away from problems and they want to forget it and don't do a good enough job of kind of taking a look and figuring out what happened and why, so they can take with them a new set of tools to figure out how to navigate the future. Talk to us about, Sean, about median price and how that can be that's what gets reported all the time. And I don't think we'll ever get rid of that metric because it's become a baseline. But talk to us about how that can how that can distort the perception of what's really going on.
Yeah, median price is a really interesting thing because what you're looking at is for the homes sold in that particular month, the point at which, the price point at which half the homes were above and half the homes were below. That's the definition of the median. So it's that halfway mark of the homes sold that particular month. When you start comparing changes in median price over a period of time, say over a year, you have to ask your question, it's not the same homes being sold that were sold a year ago, right? So when you're looking at a change in median price, you can have two different components. One is an actual change in value, right? Things went up in value or went down in value. But there also can be a change in the mix of what's sold. So if you have more high-end homes sold, you'll have an increase in median price. If you have more low-end homes sold, you'll have a decrease in median price. And so it's really measuring two things: price, changes in price, and changes in mix. And so, just a really good example here. So in California, we hear a lot of reports around 22% increase in median price.
Yahoo!
Right,
Yahoo! That sounds
right?
exciting.
That doesn't necessarily mean any single house went up 22%. So just as a simple example of this, if we separate out distress sales from non-distress sales, non-distress sales, so these are regular market sales, not a short sale, not REO, went from, in November of 2012, from 357 to November 2013, 399. That's an 11.8% increase.
Not 22.
That's a very big difference, right? It's not 22. Yep. If we look then at the distressed sales, we go from 234 to 257 median, right? If we separate those two into two separate buckets, which is a 10% year-over-year increase, not 22. So if one part of the market went up 10%, the other part of the market went up 11%, you don't add those two together, right? So how the heck do you get to 22? Well, we had a much higher, about over half the homes a year ago, around half the homes a year ago were distressed sales, and now it's about 25%. So we had a big move from a lot fewer distressed sales this year. Distressed sales, banks more aggressively foreclose on lower priced homes, and there were more lower priced homes that were in foreclosure and in distress. So we have moved from that standpoint. So a big chunk of the 22% increase last year was a change from low-end foreclosed homes to higher-end,
the mix changed
nicer
a lot.
homes. The mix changed a lot. There's no question.
So you got to be real careful interpreting this data. Yeah.
The median price
and the headlines, right? The headlines focus on these things, and many people think, "Oh, my house went up that much," but
I don't think median price should be reported.
Yep. FHFA and Case-Shiller probably better because they're tracking the same house.
Yeah, I mean that's the idea that they're doing that same home thing. There's still there's still indexes, there's still issues there. You still have to be a little cautious. But that same home model that's used by FHFA and Case-Shiller are better.
What was it, real briefly here? What was the tipping point? What was kind of the last straw that allowed us to finally start to crash and correct?
The thing I saw, we got into these crazy loans, and every deal as an investor I saw come across my desk was somebody who just absolutely shouldn't qualify for the home they were buying. And as they bought these homes with the idea they were going to go up another $100,000 the next year, because that was kind of the pace we were at.
So it was a greater fool theory.
Yeah, and then they started to see that down the street, the new home builder, the home they just bought was now, the new home builder had to throw in a swimming pool in order to get the deal closed. And it was pretty clear the jig was up. We'll talk more about that after the break.
We'll continue right after the break. This is Tom Wilson, Real Estate 360, KDOW AM, 1220 AM, Wall Street Business Network. We'll be right back with Sean O'Toole, CEO and founder of Property Radar.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back in the studio today. We have Sean O'Toole, CEO and founder of Foreclosure Radar and Property Radar. We were just talking before the break about what triggered the kind of the last straw to turn down, and what were your finishing thoughts on that?
Yeah, I just wanted to finish up by saying, that guy that watched now the free pool being given away in the house realized the jig was up and they weren't going to make $100,000, and they bought their house with no credit, or bad credit. And they didn't put anything down, so it was easy to walk away. And that's why this got called the subprime crisis at first. But really, those unqualified folks were just the first to realize
the iceberg. Yeah,
they were the first to realize the jig was up, and they walked away because they didn't have any skin in the game. So it was easy for them to walk away. Yep. It was harder for everybody else who did.
And then strategic default started to happen, and more and more people who in the past would never think about it because it was unethical said this doesn't make sense.
But it would be wrong to think that strategic defaulters and these folks that walked away caused the downturn. Mm-hmm. The downturn was caused by a way too aggressive upturn and an unsustainable price level. And
loans that were subsidized more than they probably should have been subsidized.
Yeah. I mean, we had reached a price level that was not sustainable. It doesn't really matter how.
And if it had not been for the government intervention and the low interest rates in these subsidized loans, if you will, we might have more likely had a soft downturn at more of a normal cycle, and say during the dot-com crash time. Do you guess?
Well, I think we continue to try to rescue the economy by putting out cheaper debt and blowing bigger bubbles. And, I think you could argue we're back in that same cycle today, right? We rescued the dot-com bubble with a housing bubble. Now we're rescuing the housing bubble with a sovereign credit bubble, and we're blowing up the balance sheets of the Federal Reserve, and it's happening around the world.
One thing I try to remind people frequently is that we watch the national California news, but the market's really thousands of submarkets, and the timing of each of those submarkets is quite different from one another. Usually don't get much data on that. That's where our property radar, foreclosure radar can come in. You can zero in on neighborhoods instead of just having to look at the headline news for your metro or state.
Yeah, absolutely. I mean, we talk about the state because it's easy to talk about, and we have lots of people in lots of different places listening.
And a lot of dynamics, so it gets exciting.
And a lot of dynamics.
Yep.
But
makes headlines.
The statewide numbers are really meaningless. Silicon Valley has very little in common with Southern California, has very little in common. The coastal areas have very little in common with the inland areas. These are radically different markets within the state. Yeah,
they certainly aren't much of a bellwether area for anything. It's their own economy.
Yeah.
Well, we only have a moment here before we need to take a break, but we want to start talking about what happened after the crash, and indeed, probably put a mark on about September 2008 when things radically started to change, can't we?
Yeah, absolutely. And you had the takeover of Fannie and Freddie, a lot of stuff happening right then, TARP, the bailout, which most people would think was just about loans to the banks, but that's really where the Fed stepped in and started buying mortgage-backed securities and rescued the housing market by continuing to make loans available. It's very possible without Fed intervention that there would have been no loan market, for housing, and this would have all been a lot worse in terms of the aftermath.
Two sides to every topic like that. We'll be right back with Sean O'Toole, the CEO and founder of Property Radar, talking about what happened during the Great Recession and after, where things are headed, and what we can do about it. This is Tom Wilson, Real Estate 360, KDOW 1220 AM, the Wall Street Business Network. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We have Sean O'Toole in the studio today, CEO and founder of Foreclosure Radar and Property Radar, investor and a great friend. And we're very glad to have him here helping us decipher what did happen, why, and where things are headed. And we were talking before the break about the things that changed in September 2008. Basically, government stepped in and did a lot of intervening to try to help save the economy. And some say, gee, we should have just left it to free markets, and others say, no, we should have done more. And you kind of feel that it was a good thing we did some things, I believe.
Well, I mean, what we should have done is not allowed the bubble to be created in the first place, which the Fed created, and then the Fed had to bail out. So, and let's, we can blame the banks all we want, but the banks did it with the, Greenspan right behind them, patting them on the back.
They had no risk.
Yeah. And Bernanke and all the same cast of characters that still runs, Treasury and all of that. It's all still the same cast of characters. We've had zero change on that front.
I remember as soon as things started to crash, most of the authorities out there were saying that the floodgates were going to open and there would be this huge amount of foreclosures. And you were the first one, and I think about the only one that I heard early on say it wasn't going to happen because the political entities would do whatever they could to save it and keep it from happening. And you were right.
Yeah, and it was really easy. The Fed, I think, knows they created this problem. The banks know and politicians, I think, know that they're responsible for the problem. But it's a lot easier to blame foreclosures, right? Foreclosures don't cause anything. Foreclosures are a result of something.
Symptom. Yep.
It's a symptom, So, and they don't want to address the real cause. And so, we haven't changed any of those regulations. We haven't put back in place Glass-Steagall. We've done very, very, very little on that front. And I think we learned very little from the whole episode, and I think we're at risk of, repeating it. The big lesson that's been taken away, and Richard Cordray at the Consumer Protection Financial Bureau just patting himself on the back with the rollout of the new qualified mortgage rules, because they've decided that the real problem here, the only reason we had a problem is that we didn't qualify people and its ability to repay. It's the people's fault that we had this crash. People walking away from their loans. That was the problem. I completely disagree. It wasn't the problem. It was inflated prices due to government and bank lending policies. And but now ability to repay is what's being focused on, and we've done very little to change the change the dynamic of thing. And I think we're at risk of causing future problems because our memory is short. We're already back to making adjustable rate mortgage loans and other things. A 43% back end debt to income ratio is okay. And, so if it's just, and price doesn't matter. And we want to see prices go up.
So if Sean O'Toole were dictator of the U.S. economy, what would you do?
The first thing I would do is I'd stop using the sales comparison approach to appraisal for lending. Just because 3 idiots are willing to overpay for a property doesn't mean that every property in that area is now worth that new price. And I would instead base lending off of not an individual's ability to repay, but the household incomes of that area, because that'll keep at least lending kind of tied down to rents and what people are able to pay. At least government-backed lending. I think we should go back to a free market where private lenders can lend any stupid amount they want. But in terms of government-backed loans, let's keep them down at a level that if the person stops making their payment on their house, look, you stop making your payment, get out. The foreclosure's okay. It's just a way of saying, hey, you're not making the payments, move out. It's like evicting a tenant. It shouldn't be as big a deal as people are making it. And we put somebody else in because guess what? The payment is affordable versus rents. And it's not a problem. There's no risk of loss there. And I think that's a very simple change to make. I also think, this isn't to defend the banks by any stretch of the imagination, but right now, like the foreclosure rules, they're different in every single one of 50 states. and they're changing all the time. At one point during the crisis, there was 1,500 different law changes to the foreclosure process being proposed around the United States. And that's crazy. You can't keep up with that, right? Did the banks make lots of errors through the whole thing, robo-signing, all the rest? Absolutely. But it's a pretty complex, awful environment. So the first thing I would do, dictator, I would go to FHFA. I would take FHFA, and I think they could do this unilaterally without congressional support or anything else, and say, no more Fannie Freddie loans in any state that doesn't adopt uniform foreclosure rules, uniform lending rules. It sucks. And states that don't want to do that don't have to, right? And they can find their own market and they can create their own lenders. I would change that right away so that there's a uniform process. It's clear. I would probably make it so that the person has to be evicted so they get their day in court before their house is sold out from under them. It's crazy the way we do it right now, where your house is sold and then you get evicted, and that's when you first get your day in court.
What would you do about Federal Reserve?
Oh, I don't.
That could be a whole hour. But.
Yeah, it could be a whole hour. I think at the end of the day, having an entity that helps with, balanced monetary policy and the rest is good. I think the dual mandate and the current setup and their lack of transparency, I think those things need to change.
How about quantitative easing?
I think it has a place, but you have to understand what's the goal of quantitative easing. Right now, the quantitative easing is helping not the 1%. We keep talking about the 1%. The 1%'s not helped here. It's the 1/100th of 1% that is making a killing from quantitative easing, and it's popping up in algorithmic trading, and it's. That money is not flowing through, especially to the middle class and helping the middle class. What's the goal with quantitative easing? Why are we doing it?
Thanks, Sean. Good stuff. We'll be back in just a moment for a wrap-up. This is Real Estate 360, KDOW 1220 AM, Wall Street Business Network, and we have Sean O'Toole in the studio today. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back with Sean O'Toole, CEO of Property Radar. Sean, what's going to happen in 2014, you think, real estate? And
for median prices in California, I'm predicting flat, plus or minus 5%, within that kind of range. And it's less a prediction and more of a hope. Because we've seen sales are down quite a bit, 20% year over year in December. Inventories are starting to rise. I mean, the market's shifting. Silicon Valley is a little bit different. It's one of the hottest markets in the world. Because the tech engine is driving most of the growth in the world. But overall in California, if we see increases of more than 5% and in the 10%, then I think there's no question we're getting back into bubble territory. And, I think the consequences of that are high. If, on the other hand, we start to see prices fall, I think that's equally concerning. I think that could have, it could spiral downward and get bad. So I'm frankly hoping for flat. I think we need to take a breather and regather. Interest rates are up a little bit. I think incomes will be up a little bit, but not enough.
I think interest rates will be within 0.5%.
I think probably rise somewhere in the 0.5% range, but I think they're going up.
Sean, just we have just a moment to wrap up, but you've had certainly the leading product in the Western 7 states for foreclosure information. You saw foreclosures were starting to finally fade down, and so you've been working for 2.5 years, haven't you, on your new product, Property Radar? Tell us briefly, what does it do better than other products out there?
Yeah, so our service is designed for professionals, realtors, and investors. And to some degree, we're just trying to keep them ahead of all the consumer information that's out there. The sites like Zillow and Trulia and Realtor.com and all the rest have done an unbelievable job of educating consumers. We're just trying to keep our professional customers a little bit ahead of that curve, give them access to additional information that they can use on markets. So great visualization, like where are the renters? Where are the people not renting? Where is there equity or not equity? Still concern over shadow inventory. We don't have any concern of that shadow inventory showing up on the market, but you need to be able to address that concern, and we help people visualize that. We help realtors find short sale opportunities. We still have 1.4 million folks that are underwater in California, and we help investors find potential deals to buy and make sure that they're not taking too much risk in buying those.
So if they want to sign up, they go to propertyradar.com?
Propertyradar.com, absolutely.
Good. And you got a special, don't you, for them to have a free trial?
Yes, we do offer a free trial, and we're partners with the California Association of Realtors Business Products Group, so there's also a discount for California Association of Realtors.
Check it out. And for those that still are used to Foreclosure Radar, it is still running, so we can keep going that. Sean, thank you for being with us today. Sean O'Toole, a self-taught economist, entrepreneur, and CEO and founder of Foreclosure Radar and Property Radar. It's great having him with us here today to help dissect what's going on and where things are headed. This is Tom Wilson, Real Estate 360. And don't forget to sign up for a weekly newsletter and any other information that you'd like. Let us have your questions. Remember, the only thing that matters is what you do next.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360radio.com. That's RE360radio.com. AM 1220 KDOW.